Good morning and welcome to another Market Matters video update. Once again joined by James Gerrish, our primary contributor. Reporting season wrapped up about last week. Long August for us here in the office. Firstly, your take on reporting season in general. How did we go? Do you reckon we beat mostly or missed?
Yeah, it was a pretty long month in August, as always the case. Lots of company reports to go through, etc. Overall, it was a pretty soft reporting season. If you strip out the resources companies, profits in ASX top 200 companies ex-resources were only up 1%. So it sort of underlines a weakness in the underlying Australian economy. We wrote at the back end of July in our portfolio reports just around our concern around the reasoning behind the RBA cutting interest rates. So soft economic conditions, and I think that's come to fruition throughout the month of August. But the market snapped its 7 consecutive months of gains. We're down in August, but there's some interesting opportunities always coming out of reporting, Harry.
Certainly is. All right, jumping into some stock-specific stories. Fortescue, we bought that during the month. How did you see their report?
Yeah, at the sector level, so materials were the worst performing sector on the ASX during August. Concerns around global growth, obviously weighing into the fray there. The iron ore price came back pretty heavily. So, a couple of things to think about in Fortescue. First of all, they produced a record result, no two ways about it. They beat market expectations by about 5%. They produced net profit after tax of $3.2 billion. So, a great result. The stock was down on the day of the result that they released those great numbers. If you rewind and go back to January of 2016, Fortescue is trading at around $1.34. To give you an idea, in FY19 they produced $1.14 worth of dividends. So it gives you some understanding of the cash that these guys are generating. So the business operationally is performing really well. The iron ore price is a major influence on the Fortescue share price. So, the fact that it was down caused Fortescue to drop 20% over the month. We use that as an opportunity to buy it. Our analysis suggests that iron ore is likely to be in a range of 90 to 110, given the current supply-demand dynamics playing out in that area of the market. So at 93 it is today. It dropped to a 87 low or thereabouts. At 93 today, iron ore's at the bottom of its range. I think Fortescue's at the bottom of the range. It's rallied somewhat since we bought it, but I still think it's at the lower end of that trading range. So happy with it. I think higher prices in Fortescue going forward.
Holding Fortescue for the moment. Bingo, a stock our subscribers should know, and one we've written about a lot, Market Matters. We took a good profit out of that one before they reported, with some concerns going into their report. How did you see that report, and were those concerns valid?
Yeah, we bought this really well, and then we added to it as the price increased. We took a really good profit out of it, but I was concerned going into this reporting season for a couple of key reasons. Obviously, they've bought Dialer Dump Industries, a Daddy acquisition. This was the first report that business was going to be partially integrated or integrated in, but it was the first period where the numbers started to flow through from Daddy. This is, Bingo have got a real... They've chewed off a lot, they've bitten a lot, and they've got a lot to chew on from here. My concerns were around the trajectory of the underlying business. So the stripping out the Daddy acquisition, the Bingo business actually was pretty stable, so it didn't go anywhere. They didn't grow earnings in the underlying business. Margins are an issue in this business, so they showed EBITDA margins that declined, and they didn't give full year FY20 guidance. So they're going to do that at their AGM. My concern is that they're pushing through price rises, or they're from 1st of July. They've started to approach the sort of the low-hanging fruit in terms of their customer base to push through price rises. I'm concerned that they won't be able to push through the price rises as easily as they anticipate, and they may lose volume as a consequence of that. So look, I'll be waiting for the November AGM where they'll release FY20 guidance. I think that's a bit of a risk. If I look at the market expectations around the EBITDA for FY20, the market's analysts are between 139 million and 179 million. That's a massive range. You could drive a Bingo truck through that range, Harry. So look, I'll be waiting for the November report. I've got concern about margins, and I've got concern that the infrastructure side of their business is going to feel that softness in the residential area that we've been seeing of late. Overall, though, I like the company, I like the story. It's just where to get back into it, Harry.
A very polarising stock Bingo is at the moment. Orica, they actually didn't report in August, they reported back in May. They did have their investor update June, July. How do you see that? What's their outlook like for Orica?
Yeah, this is an interesting stock because we try and focus on some industrial businesses that have got good stability in earnings and things, but are trying to sort of improve their business from the technology side. And I think Orica fits that bill. They've invested heavily in improving technology around their explosives business, etc. So as mining development continues to happen, commodity prices continue to remain reasonably buoyant. There are parts that aren't buoyant, but on the whole, commodity prices are reasonably well supported. This is a business, an explosives business, that's exposed to a growing area of the market that's doing really good things technologically, and I think that's going to come through to improvement of earnings going forward. So a business we like, we hold in the portfolio, and I think we'll do. The share price will go higher from here, Harry.
Certainly. It was only a half-year result from them, but their full year back end of this year. Moving on, Pact Group, another stock that we do own. They have been quite choppy of late. They reconfirmed guidance before the result and rallied. They met that guidance and fell on the result. What was your take there?
Yeah, this has been a pretty hard business to hold. So we bought it as a valuation play. We're down marginally on the position. You made mention of them meeting the lower end of their prior guidance. So that was a positive. The issue comes in terms of their FY20 outlook. Their FY20 outlook implies growth of sort of mid-single digits. The market was looking for growth in earnings above 9%. The reason why that's important is there's concern around Pact Group's balance sheet. The balance sheet is reasonably stretched at these levels. They need strong earnings growth to be able to recycle those earnings and pay down debt. If they can't do that, then they're at risk of needing to raise capital. I think that's the concern of the market. I think if they just went out there, ripped the Band-Aid off and raised capital, the market would be a lot more favourable towards Pact Group. But look, the underlying business is going okay. It's a cheap stock. That's why we've bought it. We bought it with the understanding that it had a lot of warts on it, that it had things that they needed to get in order from their internal perspective, the balance sheet being a big part of that. So look, I think they've guided more conservatively than they will deliver. Time will tell. It's at the risky end of the spectrum, but I think there's value in this business coming from at this point in time, and I think it does trade higher the more they can deliver on deleveraging that business.
Certainly. They dropped pretty heavily on the result, but have rallied back reasonably well.
Yeah, they're up 20-odd% from their lows.
Yeah,
so.
Certainly. Lastly, from the stocks that we do own, Flight Centre. We bought that as sort of a trading play around August. It's performed okay. We're up on the position. Are we holding that long term? What are your thoughts on that result?
It's in our income portfolio. So we bought it on a reasonable yield around 4%. The stock has rallied. It's now on a yield sort of low 3. So it's probably a bit marginal to buy as an income play now. We're going to continue to hold it in that portfolio. But just to give you an idea of Flight Centre and the changing dynamics of that business, you've got about 50% of its earnings now being generated overseas. So it's not just exposed here in Australia. And the other interesting stat is around the growth in the total transactional value. So 90% of their growth in TTV is coming from their international business. So that's where the growth is really coming from. And they gave a pretty strong update for the first part of FY20 around how the business is tracking. So for now, I think that business will probably go and test, or the stock will probably test that $50 area. Reasonably comfortable with it now. I don't think it is a long-term hold. I think it's a sell into strength. And I think it's going to remain choppy, but again, the international business is going well, and the corporate business is going pretty well as well, Harry.
Certainly. All right, from outside of our portfolios, what's a stock that you're looking at that you think reported well and it's got some upside from here?
Not necessarily that reported well. So in this sort of environment, I think there's been a lot of stocks that have been thrown out, kicked to the curb because they've got issues similar to what Pact Group is offering. So I think in this type of environment where the market's trading at, looking for some of these deep value opportunities. So IOOF is one that we don't own, but I've been starting to look at. They reported some weak numbers. There's no two ways about it. They've had probably the hardest, toughest 12 months in their history. A lot in the wealth management has had. Obviously, AMP's got its issues as well, but they've, IFL had they're going through an acquisition of the ANZ Wealth business. They raised capital to purchase that business at a lot higher levels. There's some influences that may or may not allow that acquisition to happen, or if it does, the price may be lower than they had previously agreed. So I think if the acquisition goes ahead at a lower price, that suggests they may be able to return some capital to shareholders through a buyback. That'd be supportive of their share price. If it doesn't go ahead, they'd be able to do a massive buyback on market, which would be supportive of the share price. If the acquisition does go ahead, then their earnings are going to take a big up leap in FY20. So look, I think that's a deep value play, trades on about 11 times, yields nearly 6%. So out of the box, IFL a buy around these levels.
Certainly takes you back to the Bingo Daddy acquisition and buyback once that was completed as well.
Yeah, I think you've really got to look at things, that are a little bit interesting, that has some reason why the share price can be manufactured higher from here. We know the earnings environment's tough. We've just seen that through reporting season. Interest rates are obviously low, so there's no point putting money in cash. You need to be looking at these interesting sort of investment opportunities out there, and that's what we try to do.
All right, well, sit tight, keep reading the reports, and we'll speak soon. Thank you.